Hi, Dominique. How you doing?
Hello, Andrew. It's nice to see you.
Yes, nice to see you as well, and very happy to. I guess we took off 2 weeks, so happy to kind of get back into the swing of things. And obviously, things have changed. The market assumed probably that things have changed a lot, and I know your view is maybe it's changed a small amount, but the market was over anticipating, which I guess we would say recession fears, and which you disagreed with, and this week definitely has kind of panned out your view in the
So
battle
far.
so far. So maybe to dive in, yeah, what was your take on kind of the past week?
So yeah, I mean, the most important data, of course, was the NFP. It just showed how far we are from a recession. Perhaps you're familiar with the SAM recession indicator. Claudia Sam, she was an economist at the Fed, and she's discovered that since 1970, every recession has been preceded by a 50 basis point increase in the unemployment rate over the low of the previous 12 months. And we are very, very far from an increase in the unemployment rate, since currently labor demand is growing twice as fast as labor supply. And obviously, for an increase in unemployment, we need supply to grow more slowly than demand.
Does it matter that the unemployment rate is already super low? I mean, even withstanding that, obviously it has not been going higher, but the fact that it's super low and it went up 50 basis points or something, or do you think that doesn't matter that much?
So, I mean, I have actually a picture of her indicator in my soon to be published review of the NFP. I mean, whether 50 basis point is going to be the threshold where the recession starts, or whether it's 70 basis point, no one can say at this stage. But it's reasonable to say that, when it's so easy to find a job, we are very unlikely to be in recession, and we won't be for some time.
Yeah. Okay, anything that stood out? Anything else that stood out from payrolls or PMIs or anything? Yeah.
Sure. The other thing that stood out was how well the service PMIs did, much better than manufacturing, which makes sense because I think that one of the short-term factors that's hitting the US economy is the dollar. It's super strong. So if you are a manufacturer, it's a tough world out there. While if you are selling to the domestic market, you're doing very well. And that's what the PMIs showed.
Yep. Okay. And any Fed comments last week that I guess we're pretty much 90% or higher, that 75 basis points this month, right? And then the question is what happens after that?
We can start thinking about September. And what we've seen this year is a movie repeat itself again and again and again before each FOMC meeting, where it starts at 25, 50 basis points, then some strong data comes out, the Fed says, no, it's going to be higher, and then the market prices what the Fed says. So I think we're probably going to have the same thing for the September meeting. I will be very interested to see whether the CPI comes out as expected next week.
Yeah.
I think it could be higher. But even if it is what the market expects, which is 60 basis points, it's enormous.
Right.
60 basis points month on month for the core CPI is, the Fed has lost the plot. How could we end up? And it will be the second month in a row that we have such a high print. So, just meeting expectations shows you that inflation is completely out of control.
Right. Yeah, it's a tricky one because I feel like in some cases, some in the markets or some investors are thinking, yeah, it's high, but it's the rate of change. And if it's looks like it stops going higher, even starts coming down a bit, the markets take that quite positively, that the Fed kind of at least has it under control. Plus, there'll be a lag. And I think your view has kind of consistently been it's still super high, even if it's kind of coming off slightly or stable. And that means the Fed's going to have to do more than the market anticipates.
Absolutely. I mean, you multiply 60 basis points by 12, it's 7.2%.
Yeah.
Now, isn't that super high inflation? And also historically, when inflation is high, it tends to get higher. It's like when you're trying to lose weight, if you start putting on weight, you will keep putting on weight, you will add. So it's the same thing.
Right. Okay. All right. So looking ahead, as we obviously always like to do, what is your view for the coming week? What should investors be concerned about? And also, what would make you rethink some of your views a little bit, if at all?
Okay, no. I'm always open to being wrong and always looking at the data as a main source of conviction. So obviously a lower print of the CPI, especially the trimmed mean CPI, which we have discussed many times, is a more reliable measure of inflation trend than the core CPI. So definitely a really bad retail sales number. The market is expecting retail sales a tad below the CPI, which is not a big deal because we have this ongoing switch from goods which are picked up in the retail sales to services which are not included in retail sales.
Retail sales is primarily or completely
goods and food services and restaurants.
Yeah.
So
some service, yeah.
So a super bad number, say -1%, would make me think. These are really the key ones. Otherwise, we have a few activity indicators. We have the New York Fed manufacturing survey, industrial production, small business optimism. So I'm looking for a gap between the small business and the manufacturing sector performance, again, because of the dollar strength and the fact that small businesses are mainly domestic oriented.
Small businesses are more domestically focused, so they won't be larger businesses will be feeling the impact from the strong dollar.
Exactly. The other one that is going to be interesting, of course, I have to mention the University of Michigan Consumer Confidence Survey.
Everyone's
but
survey.
I mean, it's. I think
I'll say Twitter's favorite survey.
Okay. All right. Okay. So it's mentioned. I will look at it. I don't think it means much anymore. The other one that is perhaps even more interesting is business inventories. There is an inventory cycle going on. So what I will be looking actually is how that number changes the Atlanta Fed GDP forecast, because right now they are predicting negative growth in Q2 entirely due to decrease in inventories. So I'll be looking at this one. And then, of course, we have PPI.
So that will come out as part of data from the Atlanta Fed, or that is come out separately, an inventory number, and then that will affect their calculations.
And they usually, so the latter, it will be published on our Bloombergs, and then the Atlanta Fed will use the data to update its GDP projection. And it's usually within a couple of hours of the data release.
Cool. So the inventory, which is something we've talked about for a long time, which is, and anecdotally, I know friends in the US who comment about this all the time, which is a lot of businesses took advantage. They knew interest rates were, the Fed told you interest rates were going up. they took advantage of cheap debt and they loaded up on inventories. In some cases, as has been pointed out, Amazon and others, maybe overloaded up, anticipating that demand would stay very strong even for goods. So this is a payback somewhat, but this is probably like a 1 quarter thing. But
Exactly.
and on top of that, we're talking about the transition more from goods, which was unprecedented demand for goods during COVID the last 2 years. That's just, even if that just returns to normal. Okay.
Spot on. I was actually talking to a PM who looks after a portfolio of mid-cap, American mid-cap, and his take on the inventory buildup was a little bit like yours, that firms ordered more in expectations that it would be difficult to get things, to procure things, basically. So they over-ordered in expectations that they would be undersupplied. And of course, the fact that interest rates were so low, and still are, I mean, well below inflation, makes the cost of carrying large inventories quite low. And I would add to that, the New York Fed publishes an index of global supply chains, and we've had a couple of months of improvement. So paradoxically, with more predictable supply chains, it could be that businesses want lighter inventories, but it's not a sign that the whole economy is slowing down.
Okay. Anything else? So just quick on CPI, is there components that like people should really be focused on, or you're gonna look the whole number up, just saying?
So my forecast for the end year CPI is about 4.5% to 5%. And that's based on goods prices falling, but stabilizing around 4%, and services prices that are accelerating, ending the year around 5.5%, 6%. Okay. So that's what I will be looking for in this data, confirmation of those divergent trends.
Okay. So anything else, I guess, Fed speakers, anything else that people should be looking at this week?
So the Fed speakers, they are mainly hawkish. So they are going to beat the drum for the 75 basis points in July, possibly start talking about September. We have one loan, Dove Williams, and he's been saying that, it's going to be either 75 or 50. So it's not quite 100%.
For July? Or
for July. Okay. So he's not quite sold on 75, but I mean, just look at the NFP. Look at the consensus for the CPI. It's a done deal. So yeah, not much surprises to be.
So really, the focus will be on the data and, I guess, any discussions around September. But I think you're right. I think so. Right now, it's the data, because 75 is pretty much done deal for July. Exactly.
And one thing that our listeners should be aware is that the US Economic Surprise Index, it's turning. And we at Macro Hive, we score the beige book, which is coming, it's this anecdotal evidence on the Fed district that is published 2 weeks before the actual meeting, and we score the sentiment. And we noticed a pickup in June. And given what's happening to the economic surprise index, what's going on with NFPs, I wouldn't be surprised if our score showed a further increase in sentiment. Yeah,
it feels like, in a week we've gone from the recession fears to kind of back to this kind of sanity. So,
well, I didn't.
Yes, I know. Yes. Okay, awesome. Thank you very much. As always, this has been awesome, and good luck to all our clients, and also hopefully everyone sees that we have our 3-year anniversary at Macro Hive, which has been a ton of fun. And anyone who has thoughts, ways they want to contribute, things we can do better, just want to be involved. By the way, you could share the free 1-week pass, no credit card, nothing, to 5 of your friends, which we would love. Spread the word, and good luck.